President Dombrovskis, ladies and gentlemen, it is with a great pleasure I welcome you to this seminar that the delegation of the European Union is co-organizing with the American Enterprise Institute. First of all, I want to congratulate the Institute to this new beautiful building that you moved into about half a year ago, and thank you for hosting us in this room here today. I think this will be a very interesting morning dedicated to Europe and its efforts to create growth for everyone. We will also explore the joint transatlantic economic space and the influence our respective policy mixes have on each other. From the European Union side, we have spent the first 100 days reminding the new administration that Europe and the US are profoundly linked to each other. And in no other way is it more tangible than in the influence our economies have on each other. We have also identified a shared problem, that a group of our citizens on both sides of the Atlantic have been left behind and cannot find a place in the new economy. They fear that their children will do even worse than they have done. This problem has been identified by both scholars and politicians, but we have so far failed in finding the remedies. Today's discussion will debate the merits of different policy mixes leading to growth, and hopefully an inclusive growth that could give new hope to those who feel abandoned, both by the politicians and by the industry. Thank you, Vice President Dombrovskis, for taking time out of your very busy schedule, and thank you to all the other panelists, both American and Europeans. A special thanks also goes to Michael Strain, Dalibor Rohak, and Stan Voiger from the American Enterprise Institute, and to Moreno Bertoldi from the European Union delegation, who have put this seminar together. Welcome.
Well, good morning. I'd like to welcome you as well. Thank you all for braving the rain to join us here for this important conference. Thanks also to all those who are watching the live stream and to those who will be watching the video of this conference later on in the weeks to come. I'm Michael Strain, Director of Economic Policy Studies here at AEI. It's an honor for me to welcome you and to kick off the morning. AEI has long been interested in Europe. Due to its enormous geopolitical and economic importance, AEI regularly produces research and commentary about the European economy. I'm also pleased that we frequently host friends from Europe from across the pond. Just yesterday, I sat in a meeting along with several of my AEI colleagues with 7 members of the European Parliament. AEI was honored to host Madame Lagarde 2 weeks ago here on this stage. The Belgian finance minister will be at AEI later today. The Deputy Prime Minister of Poland was here earlier this month, and on and on. We're very proud of our relationships with European academics, European intellectual leaders, and European governments, and I'm happy that today's conference will continue that relationship and strengthen it. Today's conference is on the economy of the European Union. It will consist of 2 panels, one on microeconomic policies and one on macroeconomic policies. Together that includes all the policies. I would like to thank our friends at the European Union delegation to the United States for co-organizing this important conference with us. But before we begin the panels, we are honored to begin with a keynote speech by European Commission Vice President Valdis Dombrovskis on transatlantic cooperation, jobs, and economic growth, topics that are certainly on all of our minds today. Valdis Dombrovskis is the Vice President of the European Commission in charge of the Euro and social dialogue, financial stability, financial services, and capital market union. He previously served 3 consecutive terms as Prime Minister of Latvia, becoming the longest-serving elected head of government in Latvia's history. Before becoming Prime Minister, he was a member of the European Parliament and head of the Latvian delegation in the European People's Party group, as well as Latvia's finance minister. Before joining politics, he worked as a senior economist and chief economist at the Bank of Latvia. Welcome, Mr. Vice President. Thank you for being here.
ladies and gentlemen. First of all, let me thank for this opportunity to speak here at the American Enterprise Institute. Our conversation takes place in the times of change. I believe we can withstand any change as a partnership between European Union and United States is strong. It's strong because our partnership is built on shared principles and values: freedom, human dignity, democracy, rule of law, and open economies. We are natural as well as traditional allies. Our transatlantic ties connect the largest and wealthiest markets in the world. Together, we account for 40% of the world's GDP, over half of global foreign direct investment, and almost 1/3 of international trade flows. We have company plants on both sides of the Atlantic, often integrated together into wider networks of global supply chains. Despite the emergence of other partners, European companies in the US employ millions of American workers and are largest foreign source of onshore jobs in America. Similarly, US companies in Europe employ millions of European workers. The US and European foreign affiliates directly employed about 8.7 million workers in 2015, and the figure keeps rising. Make no mistake, together Europe and United States are still the backbone of the world economy. This political and economical weight has been achieved because European Union and United States have shaped it together. We are a coalition of the like-minded. What would happen if one would decide to depart from the current order? We do not know. The Japanese haiku says, a butterfly flaps its wings and a tornado starts. Ladies and gentlemen, now that we face new challenges to global stability and economic prosperity, our tried and tested partnership is once again more effective way to overcome them. The first challenge is getting the politics of globalization right. Today, many people feel as if globalization has benefited only a lucky few. Many feel left behind. It's the case both in Europe and in the US. We need to make sure that economic benefits are shared among all, including the most vulnerable members of our societies. This is why in the EU we focus on making growth more inclusive. I will come back to this later. Globally, we have to work to ensure tax fairness. This has become a political imperative. The European Union is at the forefront of the international effort to fight tax evasion and tax avoidance. We want to enforce the OECD action plan to fight base erosion and profit shifting. We want to make sure that international companies pay their taxes where the real economic activities takes place. Second is a security challenge. We need joint actions to fight terrorism and terrorist financing. In Europe, we have to tackle security and defense risks caused by tensions and military conflicts in our neighborhood, be it North Africa, the Middle East, or Russian aggression against Ukraine. Changing borders by military force is not acceptable in the 21st century. This is why EU and the US should continue to support Ukraine's security and economic reform efforts. Third, Europe is going through turbulent times. I'm convinced that we can handle these challenges head-on. As in the past, Europe will prove remarkably resilient. But it's true that we have a lot to stomach. Consequences of refugee crisis, a rise of populism in some member states, and Brexit. On Brexit, the European Union will act as one to preserve its interest. Our first priority will be to minimize the uncertainty caused by United Kingdom decision for our citizens, businesses, and member states. The EU stands ready to launch the negotiations quickly and make sure that the withdrawal process is orderly. Through negotiations, we need to build a new partnership based on fair terms. In any case, the UK will remain a neighbor of the European Union. We have strong mutual interest in close and fruitful cooperation. The remaining 27 member states are determined to stand together. By acting jointly, we can address our challenges more effectively, be it fight against terrorism, strengthening security, dealing with the consequences of migration crisis, or strengthening the economic recovery of the bloc. Where matters of the EU economic and financial stability are concerned, these fall directly within my area of responsibility. Over the last decade, we have profoundly reformed economic governance in the European Union. Thanks to these reforms, we can now focus on growth along three clear priorities: investment, pursuing structural reforms, and responsible fiscal policies. We came out of the crisis slower than the US, but growth momentum in Europe is picking up. We are in the 5th year of the recovery. For the first time since the crisis, all EU member states are expected to grow. On average, we expect EU growth to be 1.8% both this year and next. Growth is broadening gradually across sectors. Private consumption is acting as a main driver of growth. Our recovery is being supported by accommodative monetary policy and broadly neutral fiscal stance. Certain external factors, such as low oil prices, have been helping as well, although the oil price is forecast to increase in the near future. Unemployment is at the lowest level since the crisis. Public finances are improving as well. Of course, it's difficult to discuss Europe's economy without touching upon Greece, so let me say a couple of words on Greece. While still under the financial assistance program, Greece is also set to grow this year. Now it's important to conclude the second review of the program as soon as possible to ensure that Greek economic recovery continues and that Greece can return to markets in 2018. In this regard, we wish to count on decisive support from the US government when it comes to the IMF's participation in the program. Investment growth continues to improve. The historical level of investment in EU has been between 21 and 22% of GDP. After a drop to 19.4% in 2013, it's now gradually recovering. However, there is a remaining investment weakness. It's particularly important to attract and facilitate private investment, as it represents 90% of the total investment. The investment plan, which the European Commission launched 2.5 years ago, is already showing tangible results. The European Fund for Strategic Investments, or EFSI, currently has unlocked more than 180 billion euros in both public and private investments to support projects across all 28 EU member states. Given its success, the Commission has decided to extend EFSI from 300 billion euros targeted initially to 500 billion euros by end of 2020. Besides, more should be done to attract investment by improving the business environment in member states. For example, in several member states, reforms in insolvency laws or justice systems could help to reduce the natural risk aversion that often characterizes European entrepreneurs. This brings us to the need to foster structural reforms in member states. Our experience shows that countries that have implemented ambitious structural reforms are now bearing fruit and growing stronger. Most progress is made in the areas of financial sector and labor market policies. Further reforms need to focus on opening products and services markets, boosting active labor market policies to help people find jobs, and modernizing public administrations. In several countries, low productivity growth and divergence in productivity performance across firms and sectors are holding back competitiveness. I note that earlier this month, the American Enterprise Institute hosted a presentation by Christine Lagarde with a similar message. Productivity is a key to higher incomes and rising living standards to create a larger piece of pie for everyone. And there are no shortcuts to harnessing the power of productivity. On fiscal policies, the EU countries are gradually reducing public debt and deficit levels. The average budget deficit in the euro area is expected to go down from 1.7% of GDP last year to 1.4% this year. Public debt is also on a downward trajectory, though still remaining high at around 90% of GDP in the euro area. This decrease in deficits reflects lower interest spending due to the exceptionally low interest rates. It also reflects further improvements in the labor market. More people are paying taxes and contributions, and fewer depend on social transfers. However, public and private debt levels remain very high in several member states. This makes them vulnerable to external shocks. This is why we emphasize the need of using this time wisely to keep their debt trajectories on downwards paths and reinforce their resilience. It would send a strong signal to markets and investors alike. While pursuing these policies, we are committed to making our growth more inclusive. This is vital both for economic and political reasons. We should, for instance, reform tax systems and better target social benefits. We advise countries to shift the tax burden away from low-paid labor to other tax bases which are less detrimental to growth. We also propose a better use of active labor market policies. There is also a need for more support to education and training to avoid a mismatch between the skills and labor market needs. Going back to the overall picture in the EU, we see that our policy strategy of boosting investment, implementing structural reforms, and conducting responsible fiscal policies is working. Now we need to stay the course. Of course, in the context of Brexit, we need a deeper reflection of the next steps of the European Union. That's why in March, the European Commission presented a white paper on the future of Europe, outlining 5 possible scenarios for the EU going forward with 27 member states. And at the end of May, we will publish a reflection paper on completing Europe's economic and monetary union. Moving to the financial sector. We need a strong and diverse financial sector to finance the real economy. In recent years, the EU has acted jointly and decisively to establish and apply common standards for Europe's banks. Hence, today, our banks are stronger and better capitalized than before, and we are acting to address remaining pockets of weakness. One example is high levels of non-performing loans in some of the European countries and banks. We are taking action. Member states are following EU recommendations to reform insolvency proceedings and to accelerate the workout of non-performing loans. The EU's single supervisor, the European Central Bank, is requiring banks to manage and address high levels of non-performing loans. NPLs are also increasingly being sold on secondary markets. The EU finance ministers have just made addressing non-performing loans their priority and agreed to develop a common EU strategy. To further reduce risks in the financial sector, the European Commission proposed a banking legislation to transpose internationally agreed standards into EU law. Similarly, to complete the banking union, we have proposed the last major building block, a European deposit insurance scheme. Meanwhile, work continues at full speed to build a deeper and more integrated market for capital in the EU, the Capital Markets Union. The project was born as a response to what we saw during the crisis. Bank financing became scarce, while alternative sources of financing were hardly available. Many firms were left with no funding at all, worsening the overall contraction of the EU economy. This project is thus about developing European capital markets to make them fit the needs of our firms, our real economy. However, new challenges not foreseen from the onset make our task more complex. The prospect of Europe's largest financial center leaving the single market makes this project more challenging, yet more important and more urgent. A lot has already been achieved. I'm talking about simplified prospectus requirements for firms tapping public markets and revised rules to support venture capital and social enterprises. We also propose new rules on securitization, which are currently under scrutiny by European Parliament and Member States. Now, in the light of the new political and economic reality, we need to recalibrate our project and raise the level of its ambition. For example, we want to be more ambitious in the areas such as fintech and sustainable or green finance. We will also propose new rules on pan-European private pensions and will streamline our rules on EU passporting of investment funds. Overall, this means that the European Union is holding up its end of the bargain, promoting stability and regaining trust for the long term, while reforming its economic fundamentals and strengthening growth in a shorter term. This is important because, just like US, Europe's economy contributes greatly to the global growth. Now moving to the international financial cooperation. The global financial crisis shook our economies to the core. It also showed that our financial systems are inherently linked and that financial stability requires a joint effort. Within the G20, the US and the EU have worked together to develop a common international financial governance to build global resilience. Without working jointly, we would run the risk of regulatory arbitrage and renewed instability. There is no doubt that our rules need to be, financial rules need to be fine-tuned to make them more growth-friendly. In Europe, we have done an assessment of the overall impact of our rules on the economy, the so-called call for evidence. Where necessary, we also adjusted the rules. But we are not willing to lower prudential standards, and we count on the US to stand by the same principle. This is key to our equivalence process. Our rules on equivalence, or as it's known in the US, deference, require us to monitor continuously the adequacy of third countries' rulebook and supervision to the EU standards. Now, why we consider international cooperation on financial services so important? Let me give 3 examples. The recent experience shows that it's impossible to properly manage a financial crisis without an effective regulatory framework for derivatives markets. As derivatives markets are global, they also require a global framework that no country in isolation can deliver. Since markets move to exploit the slightest arbitrage possibly and do so extremely quickly, no single country on its own can put in place effective individual margining requirements or requirements for central clearing. That's why Europe stands by the new framework for derivatives markets agreed in the Financial Stability Board. Another example I would like to mention today is bank capital charges. Today, US banks have probably as many operations in the EU as EU banks over here. The Basel framework guarantees that all these banks can operate internationally, but are still regulated and supervised to the appropriate jointly agreed standard. The EU stands strongly by the agreed standards. Recently, we, as a first jurisdiction around the globe, proposed legislation to mitigate market risk and to review the trading book. And while we want to get the new standards right, we stand ready to negotiate with our international partners on how to finalize the Basel III framework. A third example is bank crisis management. For banks to operate internationally, we need tools to deal with international banks in case of the crisis. In the Financial Stability Board, we have put together a crisis management cooperation framework that can be used within cross-border group when a cross-border group gets in trouble. We had a trilateral resolution exercise with the US and UK authorities in DC last autumn. We want to maintain and improve this cooperation. To do so, both EU and US laws need crisis management tools which are compatible with each other. So we are following very closely discussions on possible modifications on Title II of Dodd-Frank on the Orderly Liquidation Authority. We hope the need for effective cooperation will be taken into account in these discussions. Ladies and gentlemen, the US-EU political and economical partnership is tried and tested. It's based on shared values and principles. This is the main reason why it works so well. In troubled times, this partnership can give us advantage in seeking common solutions for geopolitical conflicts, reinforcing economic growth, and ensuring financial stability. It's difficult to imagine a global governance system without the EU and US as pillars of the multilateral cooperation. Laws change, governments change, the context changes, but it's important that the principles and trust binding us remains the same. Thank you very much.
Thank you very much. Okay, so now we turn to the interactive part of the program. Thank you very much for your remarks, Mr. Vice President. I'm going to ask a couple of questions, and then we'll turn to the audience for questions. So do think of your best possible question, and maybe I will call on you. But first, I want to go back to the Commission white paper that you mentioned on the future of the European Union. The white paper sketches 5 scenarios that basically cover the full spectrum of possible future paths for the European Union, from reduced cooperation to much strengthened cooperation. What I would ask you to discuss a little bit is at what moment will we know which one of those options is going to materialize? Does it depend mostly on the outcome of the elections in Germany and France? Do you think there will be continuing uncertainty until after the Brexit process has been completed? How do you see the role of the Commission and national leaders there? Could you discuss that a little bit?
Well, indeed. As a response to Brexit, we think we need a deeper reflection of where EU of 27 member states will be heading. So that's why we prepared this white paper on the future of EU, outlining 5 possible scenarios, different scenarios, from carrying on as we are doing now, to concentrating only on single market, to really going for much deeper cooperation within EU 27. So there are different scenarios, and I think we need a proper debate among European institutions, among member states, about broader public. So what our future paths will be. So we hope that we will be able to come to the more clarity as of potential future direction still during this year, because we cannot discuss it for many years. So we certainly need to set this direction, but it's important that we discuss different scenarios, we see pluses and minuses, and we can agree as a EU. And I would say everyone will have its role to play here, both European institutions like European Commission, European Parliament, but also member states. So at the end of the day, we would need as broad consensus as possible for this chosen scenarios and to succeed.
I see. But from your remarks, it seems clear what the European Commission would like to see, right? Which is strengthened cooperation, certainly in the economics area. Do you think that those goals will be accomplished? How do you see the political risks there?
Well, actually, at this stage, we have refrained for saying that out of those 5 scenarios, this is a scenario which European Commission prefers, because we think that we really need this discussion. So at this stage, indeed, we have not prioritized one of the scenarios. We may see probably more disadvantages of rolling back our cooperation, of limiting it to the single market only, but there are different ways how to go forward. If we agree all 27 countries to move forward, or there is a possibility for those countries which want deeper cooperation actually to go for this deeper cooperation while maintaining the framework of cooperation for all 27 countries, or concentrating on certain policy areas. So there are different ways how to deal with this, and at this stage we are not willing to prejudge this. We're willing to have a discussion and hopefully to come to more clarity and some conclusions towards the end of the year.
I see. In your remarks, you emphasized the importance of the relationship between the United States and the European Union, also as it affects coordination of various policies. One policy area that you mentioned briefly is that of corporate taxation, and you expressed support for the idea of taxing business activity where it takes place, which has also been a long-standing OECD objective. The U.S. is considering, certainly the House of Representatives is considering a corporate taxation framework that moves from that kind of sort of origin-based, where production takes place, taxation, to a destination-based system, where it is the location of the consumer that drives where corporate income or cash flow is taxed. Do you think such a shift would fit into the broader OECD and EU objectives of preventing base erosion and taxing corporate activity where it takes place?
Well, as regards this OECD BEPS initiative, so fight against base erosion and profit shifting, I would say that available tools are already quite well outlined, and what we need to do now is basically to concentrate on implementation. And on EU side, I would say we have been in forefront of this effort. We have already implemented a number of these OECD BEPS provisions, and in a number of areas we have been actually more ambitious than the OECD proposal, because within EU we have scope actually to go for a deeper cooperation in a number of areas. Our expectations therefore would be that our international partners also stay the course as regards implementation of OECD BEPS initiative. As regards tax changes you mentioned, you were properly referring to border adjustment tax. As I understand, this is one of the options which is being discussed, but it has not been decided or finalized yet, and indeed there are certain concerns as regards compatibility with WTO rules, and also already agreed bilateral agreements. But at this stage we only note that this discussion is ongoing.
I have one last question before we turn to the audience. You briefly mentioned the European Fund for Strategic Investments, which is a tool to facilitate public-private collaboration on the infrastructure and other investment side. The Trump administration has at times mentioned plans for infrastructure spending that looks a little bit like this fund, right, where it's a mix of tax credits and private spending. I wanted to ask if you could share some of the lessons learned from the European Fund for Strategic Investments experience so far. What do you think the strengths are of the approach followed there? What advice would you have for the new administration as it considers options for?
Well, certainly we are more than willing to share our experience as regards European Fund for Strategic Investment, and if the US finds anything useful in this experience, it certainly can draw from that. It's worth, of course, noting the context in which FC has been created. When we are looking what is really holding back investment in the real economy, it was not necessarily the shortage of liquidity. Indeed, ECB is pursuing very accommodative monetary policy, so liquidity is available to the banks, but unfortunately it's not triggering down to the real economy to the extent necessary. And assessing this issue, the conclusion was that the main driving factor behind this is that since the crisis there has been increased risk averseness both by entrepreneurs and by creditors. And in a sense, this FC with its first risk guarantees and other tools came in to address this risk averseness and unlock some projects which would otherwise not happen. And we see that indeed there is a very substantial demand for that kind of instrument, and already now we are expanding the FC, as I was mentioning, to €500 billion by 2020. So there So therefore, the question is for the US authorities to which extent they are confronted with the same problem of risk averseness, and to which extent this experience of FC could help.
Thank you very much. Let's take some questions from the audience. Robert Barrow.
In mentioning Brexit, you indicated the response of the EU.
Hold on, Robert, do you mind waiting for the mic? Sorry.
Thank you. You mentioned the response of the remaining 27 members of the EU would be to act jointly and to enhance cooperation. That sounds good, but another way to think about cooperation is it's really the absence of competition. And it really amounts to having more of a monopoly government rather than having to sort of compete with what other governments are doing. In some contexts, it can be desirable to have this sort of cooperation or monopoly, maybe for promoting free trade in goods and services, financial services. But in other areas, it's problematic. And in particular, I think it tends to promote larger government, larger spending and taxes, and I think it tends to promote regulatory expansion that's too big. It doesn't cater very well to different views on what the proper role of government is in various areas. For example, the level of taxation, welfare benefits, regulations, how to treat labor markets, antitrust. And I think in many of those respects, the UK had a different vision from what I believe is the average vision in continental Europe. And I think that had something to do with the pressure for separation. I also think it's true that Brexit will promote more cooperation between the UK and the US, perhaps in the form of a trade agreement. And that would be further competition for the EU, and I think that would be desirable because then the EU would have to respond also in terms of that kind of extension.
How do you see this? Do you think that the Brexit will lead to welcome competition and ultimately to better governance everywhere? Or do you think that the disadvantages will ultimately outweigh the
it's worth noting that EU single market is currently the largest global market, and there is lots of competition taking place within this EU single market. And indeed, one of the economic criteria when assessing new member states joining the EU is whether that country's economy is able to withstand competitive pressures of EU internal market. Because it means that countries have basically to open up their borders. EU is, among other things, also a customs union. So there is a lot of competitive pressure actually within the EU. But what EU single market provides is a level playing field. And if you think what is a level playing field, yes, indeed, it implies certain degree of regulation. It implies certain enforcement of what we call state aid rules. It's not possible that one country starts to subsidize products to sell it in other countries if there are no borders. So there is quite strong enforcement of state aid to prevent that kind of practices for happening. So it's all actually to ensure this effective functioning of the single market. At the same time, EU is not prescribing the levels of direct taxation. So EU is not telling what is a level of corporate income tax or personal income tax member states should have. And EU is not prescribing the levels of social benefits. It's also for member states to decide in line with their traditions, in line with their economic and budgetary possibilities. And we see that actually those practices vary quite widely across the EU. And I think from that point of view, this approach we are having to the single market is an approach which we are going to broadly maintain. So the question is how we can closer cooperate or concentrate also on other policy areas behind pure economy.
Thank you. Let's go over there. Please wait for the mic and briefly introduce yourself. If you
Yes, my name is Christopher Asruni. I'm from the Danish Ministry of Finance. And I would like to follow up on Robert Barrow's question with some more concrete examples. It seems to me that in the European Union there's a quite good analysis of what the problems are. We need more flexible labor markets, and we need higher productivity thanks to more investments. But it also seems to me that the EU, in some respects, is working in the opposite direction of that. For instance, in the EU, I might be mistaken, but it seems to me that strong forces are working in order that the countries should have legally fixed minimum wages, which is not in accordance with the idea of flexible labor markets. It would hurt low-skilled workers. And in the EU, there are strong forces working in favor of a financial transactions tax, which would hurt investors and would not enhance productivity. So the devil is in the details. It's very good to say that the individual countries are free to compete within the internal market, but some forces in the EU are working in order to stifle labor markets and introduce new common taxes on investments. And that seems to be in some kind of opposition with the analysis that you put forward.
Well, once again, I would re-emphasize this issue of the level playing field, which certainly requires a certain degree of regulation. Certainly, EU internal market is not free for all. That's so. Then coming to your specific examples, first on legally binding minimum wage. Practices vary across EU member states. Some of them have legally binding minimum wages. Some of them set minimum wages through collective bargaining systems with the social partners. And I think these differences have to be respected. And also in those new initiatives, which we are currently discussing, for example, European Pillar of Social Rights, this need is currently certainly taken into account. Then on FTT, there is another form of cooperation which we have in EU, that certain member states, if they decide that they want to cooperate closer in certain areas, may do so. And indeed, there is now, well, initially, if I'm not mistaken, there were 11 member states, now there are 10 member states, which are discussing FTT. But it's then those member states' choice. If those member states want to have financial transaction tax, they can discuss and they can agree. Those member states which are not interested in this initiative can stay out of this initiative. So this is one of those possibilities, indeed, that those which are willing to do more or cooperate closer in certain areas can do more. But those which don't are free to stay out of those initiatives.
Thank you very much. I think with that, this part of the program comes to a close. I want to thank you very much for speaking to us and taking a number of questions. We're going to immediately go to our first panel once the logistics are done here and I hand someone my mic. But thank you very much again, Mr. Vice President. We hope to welcome you here again soon.
Thank you. Okay. Thank you very much.
Thank you very much.
to your original email about your direction for the panel, but I took it as gospel.
Good. I like that. That's the way to approach my instructions. Good morning, everybody. My name is Dalmir Rohak. I'm a research fellow here at AEI, and I'll be moderating this morning's panel on structural reforms. I suppose I have some bad news and I have some good news. The bad news is that we are still missing one of our panelists, Elena Flores from the European Commission, but we do hope she will turn up shortly. And the good news is that if she does turn up, we will end up with a gender-balanced panel, which certainly is a very rare thing at economy-related conferences around Washington. And I'll just note that you are seeing it at AEI. You are not seeing it at one of our friendly competitors on the political left. Obviously, while we can make this claim to gender parity at this panel, we can't really claim that this panel is balanced geographically, because half of our panel is from Sweden, which might make sense given the topic of the discussion. And I extend my welcome to Mrs. Flores and invite her to the podium now. So the topic of this panel is related to structural reforms. Structural reforms obviously have given rise in some circles to somewhat lazy thinking, in the sense that if you encounter an economy that's growing sluggishly, most people will say that's because it needs structural reforms. And when we press them what those structural reforms are, they will tell you that those are reforms that will enhance the growth prospects of the economy. So I hope we can sort of get away from the circular reasoning towards specifics of what is exactly holding back European economies individually and collectively from realizing their growth potential. And so we'll try to look at the priorities in member states of the European Union, the sort of immediate low-hanging fruit that could be tackled by policymakers. We'll try to look at the role to be played, if any, by European institutions in enhancing the growth potential of the European economy, and also at the transatlantic dimension, and what the US government can do to help. First, I'd like to introduce the members of the panel, starting on the far right from your perspective, perhaps not politically, with Anders Oslund, who is a senior fellow at the Atlantic Council and one of the world's leading authorities really on transitional economies, author of 14 books, worked at the Peterson Institute, Brookings, Carnegie, Cannon Institute, taught at Stockholm School of Economics. We are absolutely delighted to have him here. He has been involved heavily in the reform process in recent years in Ukraine, and has written extensively about Europe as well. Carolina Ekholm is the State Secretary to Minister of Finance of Sweden, and she was previously the Deputy Governor of the Riksbank, the Swedish National Bank, and she had a successful career in academia prior to moving to public service, having taught at Stockholm University, holding a fellowship at the Research Institute of Industrial Economics. Her academic work mostly focused on international economics, foreign direct investment, labor issues, trade, and more importantly on the interplay of these three things in the context of small open economies. Ibrahim Rahbari is the director in the international in the global economics team at City Research in New York, where he works on monetary policy, investment, debt, deleveraging, long-term growth prospects. with a focus obviously on the Eurozone. He's been very closely following the debt and financial crisis of the Eurozone, and can provide a very informed opinion of how the private sector is looking at some of these European challenges. And finally, Elena Flores is the Director for International Economic and Financial Planning and Global Governance in the Director General for Economic and Financial Affairs of the European Commission. And like other panelists, she also has an academic background, having taught at the Autonomous University of Barcelona for quite a few years before joining the European civil service. So what I would like to do is to ask each of our panelists for very brief opening remarks, and then I might decide to ask some questions myself, and then we'll turn it to the audience for Q&A. Anders, please, the floor is yours.
Thank you. Thank you very much for the invitation, both from the European delegation and American Enterprise Institute, and your kind presentation, Dalibor. Just wanted to show you, this is our most recent book that Simeon Djankov, the former Minister of Finance of Bulgaria, and I have written, Europe's Growth Challenge. What we are trying to do in this book is exactly what this panel is about, present a list of the key structural reforms that the European Union now needs. And our basic argument is that Europe is growing far too little. Europe has been lagging 20% behind the US since 1975. There's been no convergence whatsoever. And the reasons are not very difficult to understand. It's too high fiscal burden, in particular too much tax burden and regulatory burden on labor. That alone explains almost half the difference between the US and Europe. And then we also have a problem that was discussed before with markets that are not functioning. There are three big markets that are not working. First, I should say, the manufacturing single market in the European Union is outstanding. That's a big advantage. The problems are the service market, only half is there because of national regulations. This is not the EU that is the problem. It's that the nations are not deregulating the markets. The second is the digital market. That is hopefully coming now. It's a top priority, but it's not there. And what Vice President Dombrovskis talked about, the capital market, is not there. In particular, venture capital in Europe is 1/10 of the US venture capital. You don't have risk capital. Europe is still dominated by banks, not necessarily British Isles and Northern Europe, but the bulk of the continent. And our thesis in this book is that Europe can raise its GDP growth by 1% a year through structural reforms. This has nothing to do with the fiscal stimulus or monetary stimulus. Europe is done in that regard. With 90% of GDP in public debt in the Eurozone, there's basically no fiscal space. If it could be useful, I doubt, because it's the countries that have the least public debt that are growing the fastest. So clearly this has not worked very well for countries like Greece and Portugal and Italy that have highest public debt. This is simply a lacking thinking. Instead, we should look upon the structural reforms. And with regard to the discussion before here, I would like to say European countries have enormous possibilities of making their own choices. In each case, we see normally about half a dozen countries that are performing outstandingly by any standard. And then we have a lot of laggards, and they are different in different regards. So your question, Professor Barrow, before, if you take the income taxes, the highest marginal income tax varies from 10% in Bulgaria to 57%, unfortunately in Sweden. That It's enormous difference. Where we do see that tax competition really works, it's where the US has failed to reform in corporate profit tax. The corporate profit taxes are now from 10% in Bulgaria to 34% in France. And they are coming down all the time. Countries like Sweden and Denmark, properly exposed to tax competition, I like tax competition, they are down to 22%, and therefore has a good enterprise environment, compared with 39% in the US if you include the state taxes on top of the federal taxes. And who is next? Japan. So these two big island economies, they are missing the tax competition that we are seeing in Europe. But the big thing that needs to be changed is on the labor market. And on the labor market, there are two big problems. The first is taxation. People are complaining about inequality, rising inequality, and taking as a granted, rightly so. But why? What is policy doing about it? Both in the US and in Western Europe, taxation of labor can be up to 3 times as high as of capital gains. The billionaires pay capital gains tax, which is often around 15%, while ordinary people pay first a high income tax and then, in effect, an equally high payroll tax. Why put so much taxes on labor? Well, because labor is there. It doesn't move very fast. Capital can't be taxed. So how do we equalize this? Well, cut the taxes on labor and cut the total fiscal burden accordingly. It's unrealistic to think that we can tax capital gains much more, but we can't punish labor. We can't punish the real middle class, as is being done now, both in the US and in Western Europe, much less so in Eastern Europe, because in Eastern Europe people know that things can't be taxed like that. So what should be done more? Fiscal burden has to come down. I think that this is a major cause, apart from the labor market problems, that Europe has so little growth. The average public expenditure in Europe is now 47% of GDP, which is far too high. You can see other advanced countries like Japan, the US have 37, 38% of GDP in public expenditure. But as usual in Europe, you have some countries that are doing the right thing. Public expenditure goes from 34% of GDP in Ireland, which, by the way, has a very good growth for a very long time, apart from a certain upset during the global financial crisis that I don't think that we should see as a too big black mark. And Finland, that has now 59% of GDP in public expenditure. Sweden used to have 71% of GDP in public expenditure in '93 during the financial crisis. It's now down to just over 50%. Sweden in 15 years took down public expenditure by 20% of GDP, showing that this can be done. And this was a period of high economic growth. So it's not a question of this being negative for growth. On the contrary, it cleans out the economies that it can grow faster. And this is what the European countries should do. I don't think that any country should have more than 42% of GDP in public expenditure. There are 9 EU countries that are below that line. But this is up to the countries themselves. The EU has no standing on this. I think it would be better that it had. Thank you.
Thank you.
Well, I have partly similar views as Anders, but perhaps also partly diverging views. But I would like to start by acknowledging that, there are still a number of countries in Europe, and in particular the Eurozone, that haven't really fully recovered from the crisis. I think the financial crisis hit the Eurozone or some countries very hard because of macroeconomic imbalances that had been built up for many, many years. I mean, essentially since the creation of the monetary union. And adjustment has been very slow. And of course, anyone who has been studying currency unions would realize that adjustment to imbalances are likely to be slow and painful in such a construction. And that means that the kind of imbalances that were created within the Eurozone, I mean, they probably shouldn't have been allowed to develop in the first place. And I think that's one important lesson from the crisis. And it's also the background to some of the changes in governance at the Eurozone level that we've seen the last few years. But for these countries, I mean, macroeconomic policies are essentially out of the reach, I mean, for the reasons that Anders mentioned. I mean, they're essentially exhausted. Monetary policy is out of the reach because it's carried out by a supranational institution, but arguably also monetary policy is as expansionary as it possibly can be, or at least more or less. Fiscal policy is out of reach because the countries that would perhaps need that kind of stimulus have very weak public finances, as Anders mentioned. So this means that for these countries, structural reforms are really the only way to make any progress. I mean, in my view, I would probably single out, in terms of areas that needs to be dealt with, the financial market or the financial sector. And I think the project of creating a banking union, as the Vice President Dombrovskis was talking about, I think that's a very worthwhile and important project. And it's something that potentially could break this very negative feedback loops that we've seen between weak banking sectors and weak public finances in parts of the Eurozone. But the banking union is incomplete. I also, my impression is that progress is being hampered by a certain inability to deal effectively with the legacy of having many weak banks around in Europe. Some of these banks probably need to be resolved or restructured in one way or another. They have, many banks exhibit low profitability, high levels of non-performing loans, as also was mentioned by Vice President Dombrovskis. But there's very little progress in this area, and this also makes it difficult to go forward with the parts of the banking union that isn't in place already, such as a common backstop for a resolution fund, a common deposit insurance scheme. So I think, and also capital market union is, I mean, it's important because it would, having more diverse sources of funding for the real sector would be helpful given the weak state of the banking sector in many countries. So I would think that that's a very urgent area, but then there are, of course, other areas where structural reforms are needed. Having more efficient public administration, open up sectors and professions for competition. I think these are areas that are very important. It relates to what Anders said about services, the services market. But I would think that in order to do these things without unduly hurt already disadvantaged groups, you also need to focus on education and training and active labor market policy. also things that were mentioned by Vice President Dombrovskis. And I think education is probably an area where almost everyone can agree that more could be done to improve both quality of education, but also extend the availability of education to more people. And if you look at unemployment in Europe, I mean, it's very clear that it's very strongly negatively, unemployment risk is strongly negatively correlated with levels of education. Then I would maybe, as a final point, mention policies to increase the labor supply through trying to increase incentives for labor market participation. That's, I mean, could be done through earned income tax credits or cuts in benefit replacement rates in benefit schemes like unemployment insurance. I mean, that's something that has been done in Sweden, it's been done in Germany and certain other countries. I think with these kinds of reforms that would potentially expand labor supply, you need to think about more carefully maybe if there's slack in the economy or not. I think Sweden here is a fairly good example. I mean, there were significant reforms undertaken in 2007, 2008 in order to increase incentives to participate in the labor market. And just when those reforms started to have an effect, the economy tanked because of the financial crisis. So you increase supply, but demand was really going through the floor. So I think in the long run, employment rates, they tend to follow labor market participation rates, but that may not be true in the short run. So if, I mean, if you are going to spend your political capital on sort of supply side related reforms, maybe if you have a lot of slack in the economy, that's not where you would want to spend that capital. Then it may be more useful to spend that capital in other areas. But that's not to say that these kinds of reforms in the long run are quite beneficial.
Thank you.
Okay, well, it's a great pleasure to be here, and I was hoping to give you a bit of a sense of what I think people in the private sector and perhaps in financial markets are expecting in Europe. And I really want to make four brief points. And the first one is that I think overall, most people in financial markets are still relatively cautious about European prospects. And that doesn't come as much of a surprise, but I think it's still worth highlighting. You can see this across a whole range of measures. We like relatively simple measures, but for instance, in equity markets, relatively simple valuation matrix that our colleagues tend to use, whether that's price to book values, whether it's sort of more longer term measures, they generally tend to say that European assets, particularly in the stock market, are perhaps valued at around 60% of the value of assets in the US. And historically, on average, there has been a discount, and it tended to be perhaps, so European assets tended to be perhaps in the 70 to 80% range of what Americans' assets would carry. But there has clearly been some downward trend in recent years, and it's been relatively steady ever since the beginning of the European sovereign debt crisis, so around 2009, 2010. And it's, of course, been volatile, and it has tracked some of the ups and downs of the political and the economic cycle in Europe. But by and large, it's been a move downwards. Probably, and I hope we've seen somewhat of a bottom of it recently, but still the differential is to the US is pretty big. My second point is that when you look at these measures, I do think they suggest or they reflect a combination of both a degree of pessimism about European prospects, but then very much also greater uncertainty. And that uncertainty, of course, is expressed then in a greater risk premium for Europe. When it comes to the pessimism, I think we have to take it with a grain of salt, but most people tend to agree that average growth prospects in Europe are lower than they are for developed markets as a whole or for the US. You tend to think that that long-term growth differential isn't massive, but it is probably about 0.5% to a percentage point, even though it's obviously not indifferent to the sorts of structural reforms that we're discussing here. But there is also this element of a bigger risk premium. And I think there are many ingredients to this risk premium, and I'll come back to a few of these. But I do think the political element to that risk premium has been growing. And it hasn't fallen as sharply as financial risk premia have fallen over the last couple of years. So since 2009, 2010, even more so since 2012, a number of financial stress indicators have really diminished in the Eurozone. If you account for those, you end up finding a greater residual. So residuals tend to be a measure of our ignorance, but I don't think it'd be the worst interpretation to think that that residual probably reflects factors that we don't tend to take into account too directly in financial markets, often in the political realm. And this week, of course, is a great example of one where I think political factors are very prominent in financial markets, and the outlook is certainly being clouded by political uncertainties. Now, my third point is that there are some good news when it comes to things that can be done, and perhaps for structural reforms to be able to address some of these issues. One is that there is, and as Anders Aslund mentioned to some degree, there is room for a national government to undertake many reforms. So there's room for maneuver for reforms to be effective, and that financial markets tend to respond to these. Not necessarily immediately, but in the last few years we've seen examples in Europe, and I think Spain is probably the best, where not only structural reforms took place, but we have seen that being recognized not just in how financial markets price asset values, but also in the movement of capital. So we see not a perfect, but a pretty close correlation between, for instance, FDI inflows and the change in prospects between various EU and Eurozone countries, even in the recent past, even more so over longer periods of time. So financial markets do respond to these, and even more so, I think there are a number of structural reforms that can probably address both aspects, both categories of that financial market underpricing, if you like, the longer term growth prospects, but also some elements of the risk premium. Not the politics, unfortunately, but when we think about other elements of the risk premium, be that towards the microeconomic or towards the macroeconomic end of the question, I think structural reforms can help. And I think two good examples are, among many, are, for instance, around judiciary reform and more generally the rule of law. And there are a number of countries, mostly in the south of Europe, where I think making those more efficient would make it much easier for the private sector to invest. So that's both to make judicial processes more efficient, but also, in many cases, reforming bankruptcy laws, insolvency procedures, and so forth. And the other is towards the macro end. We've already heard financial markets, financial market reforms, removing uncertainties about sort of critical vulnerabilities in the banking sector are clearly among the things that can both boost near-term growth prospects, but then very much remove chunks of the risk premium. So I think the good news is there is a lot that can be done, even within the current institutional setup that we face in Europe, and I think the national governments are very much the first in line. But my fourth point, obviously, if there's good news, there's probably also some room for continued caution. I think one is, I think there are areas that are genuinely tough to address, and by tough to address, I mean probably to some degree unlikely to be addressed anytime soon. I already mentioned the political risk element of prospects in Europe is a significant one, and one that I can't see go away or even fade in any significant manner. I hope this year will be a local peak, but I don't think these issues will disappear entirely for years to come. Even the issues that were brought up in Mr. Dombrovskis' conversation around what does the European project stand for these days? What is the vision about Europe? Just having some clarity about what Europe is meant to achieve, I think is relevant in two ways. It helps to make us in the financial sector and in the private sector understand it, but also it, I think, makes it easier to find an efficient institutional arrangement in Europe. a version of an institutional arrangement that isn't a lowest common denominator, which I think is one of the things that's holding back Europe in some ways. And I think that's partly that you see inconsistencies here and there among the orientation, but it also applies to really the ability of Europe to react, the EU to react. So decision-making procedures, which obviously have been a focus for a number of years, including revisions to treaties over the years. But I think that's one area which I suspect is very difficult to change. But making it easier for the EU to take action, to respond, be that on the structural reform side, but also on much more shorter-term issues, is one of the areas that I think would be very impactful. But I see a little prospect of that happening anytime soon. And then finally, and I hope Elena will prove me wrong, I get the sense that right now there isn't a great deal of momentum on the structural reform side in Europe. Obviously, there are initiatives like the Juncker Plan, the investment plan. But if I had to list the list of major initiatives that would, in particular, help the weakest countries to come out of their sort of relative stagnation, the biggest concern for financial markets tends to be around Italy. It isn't that easy to find confidence and that much hope around the corner. I do think part of that is because good news. We are seeing a broadening cyclical recovery in Europe, and I think that's likely to run quite a lot further if it isn't stopped by major adverse events, and that's great to have. We had to wait for a long time for that cyclical recovery to come through. But on the margin, it probably also makes the sense of urgency among policymakers a little bit less acute, and that might well come back to haunt us over time. Now, I don't like to end comments on a pessimistic note. So one thing that gives me some hope is, if the AEI and the European Commission can find common ground, or at least are having a conversation about structural reforms, then I think maybe I'm underestimating the enthusiasm and the urgency that European policymakers are having on these issues.
Thank you. I guess we'll find out now. I would like to ask Elena, is the European Commission on the side of structural reforms or not? And how do you see this conversation going forward in Europe?
Okay, thank you very much. The advantage of being the last one is that many things have been said, and I think that I disagree with very little of what has been said, maybe with some differences about where to put the focus of reforms, but surely not on the relevance of reforms, not only because it's the sort of the only remaining policy, but I think in any context, structural reform is a key ingredient for making the whole policy mix delivering the best possible outcome. So that I think we are clearly pushing on the same direction. Maybe I would like to put that my comments in the context first, which is well known, but I think it's worth to recall, is that all advanced economies with different degrees, but we are all facing a decline in productivity for many years before the crisis, accelerated by the crisis and continuing. So this is one common issue that we all need to address, is productivity growth. And I think that's the key for most of the others to on the one hand, to be able to undertake reforms that can have sort of both short, medium-term and longer-term effect at the same time, which is what is difficult, and reforms that can be acceptable because every party involved, let's say economic party involved, can see what are the the potential benefits of these reforms. So that's the one element of the context. Then if we then look at the European context, I think that there are maybe 2 or 3 elements worth to mention. One, already mentioned, the banking sector, in particular in some countries there are still issues to be addressed. Profitability, I would say it's maybe more widespread across countries. NPLs is more specific, country specific, so I wouldn't like to give the message that Europe is in a huge problem in terms of NPLs. I think it's very country specific, but profitability, it's maybe a broader issue. To debt, both public and private, again with differences across countries, but there's still a legacy element that it is hindering on the economic situation. And then the adjustment of the imbalances, which has been pretty huge on deficit countries, less on surplus countries, and maybe there's some rebalancing would also be benefiting and supporting the recovery that you pointed out. It's now finally really taking ground for a number of semesters or even years. And the other element which we also see in Europe is that the convergence across countries has not continued, and this is an issue that needs really to be looked further. Whatever is not only an element of north-south. I think there is a bit more complex than this, and okay, we have done some technical work on that, try to understand better what really explains, but okay, that's an issue by itself. And also the income distribution or income inequalities within countries, which is not only a European element, it's an element that we find across the board, both advanced and emerging, with different degrees. And there, what we also see is that it is not a sort of a fatality, because we see that the developments in terms of income inequalities within countries depends very much on the country policies. So policy matters for that as well. Finally, another element that I wanted to put in the context is because this is related to the institutional and so on, is I think there is a lack of clarity in Europe about who is supposed to do what, I mean European level and national member states level, and who is responsible for what, and therefore the shaping the expectations, not only in financial markets, but in other economic actors, I think it's pretty difficult. Because I see from my perspective that there are a lot of expectations about what the European level should do or could do, which is not necessarily what the European level can do, or not even what it should do. So I think that we are a bit confused, not only at the level of the European institutions, but also at the level of member states, sometimes because that confusion helps politically, but I don't think it helps in terms of making increasing confidence and making the reforms more likely, I would say. And last element in this context picture, I think that in the longer term, I mentioned productivity, but I think we have to think about these reforms taking into account globalization, aging, and technological change, because this is there for all of us. And I think it's somehow a biggest challenge than anything else that we can identify at the country level. So that for the context. Then some of the lessons that we learned during this process, during the latest years of reforms, let's say after the crisis, well, the question would be what kind of structural reforms are needed, and obviously the answer in many cases is everything. But there is an issue of priorities and an issue of sequencing, which is very important. And my sense is that there is no universal recipe for this. I mean, we have theoretical analysis of many institutions and academics showing some sort of better sequencing and so on, but I think that it is very country specific. But in any case, it is an element that it is important to be discussed and taken into account when designing the reforms. I said that there is clearly the need to address productivity. There is clearly the need to improve all the elements that are relevant for the investment environment, and that comes to regulation, taxation, certainty, legal institutional environment, making sure that the institutions that are supposed to regulate the markets work efficiently and quickly and with certainty. We have to address the labor market as well. This is very obvious, but I think that at this stage we need to go very deep in the specificity of what kind of labor market reforms, because we have many different examples and countries are at different stages of these reforms. You mentioned one very relevant aspect of increasing supply when demand is at the lowest level may lead to the wrong result. So, but there are other elements that are almost in all circumstances going to deliver positive, like education, like training, like active labor market policies, working efficiently, the institutions that are doing that as well. So I think it's important to go to the very detailed level of disentangling what is relevant for that country at that point in time. And that's part of what we try to do also at the European Commission when we do this annual exercise to recommend policy reforms in the countries. although we try to be limited and just pick up some of the priorities, not going all over the place, but we try to help, let's say, the countries to focus on what should be the priority at this point in time in terms of reforms. What member states are doing, well, I think that again, it's country specific. My view is that a lot has been done. I mean, some countries reform, as you mentioned, before the crisis. And they did the big reforms, particularly in the labor market, and then they really saw the benefits after all. Some reform in the middle of the crisis was very difficult, but it has been done. Some are lagging behind. But what I don't really like is this sort of general judgment that Europe is not doing reforms and that there is a sort of Northern Europe reformers and Southern Europe lazy. I think that it's more subtle than this, and you mentioned Spain, and you see that also reflected in terms of growth performance, current growth performance, and I really think that some of these reforms really start paying off, and it's not only financial market reaction, but you see that there is really a movement towards a change in the fundamental structure of the economy. The problem is that there is a sort of lag or big lag between that and the translation into employment. And if you think a country like Spain, we see that growth rates are going well. We see that unemployment is still very high, but clearly the economy is moving from a highly employment component, which was the housing, basically. And obviously nobody wants to see the country going back to that. So the sectors that are now more picking up are less employment heavy than the other ones. So there is a transition that it's difficult to manage politically, and that's the difficult thing with the structural reforms. But still, we see that these reforms pay off. And then something that it's maybe less visible. I mentioned this annual exercise at the European level to try to push reforms in the countries, or to push the priority reforms in the countries. There is a lot of activity which is more of a technical nature, I think, going on, and Carolina knows that very well, in the various committees, etc., to discuss benchmarks, to agree on certain principles for reform, on the tax wage, on reducing the tax wage, on investment environment, etc. This is not very visible, but I think after a certain time that really pays off, because there is a sort of common mindset, and people can see what really works and how can reforms work, what is needed to put in place to help reforms working. I would say that in that sense, how to help reforms working, I think that it is the issue of sequencing, it's important, and our view is that in the latest years, what we are lagging generally across member states is product market reforms more than labor market reforms. And we think that is able to deliver a lot of good benefits, both in terms of improving productivity, but also in terms of the functioning or the capacity of the economy to adjust. And we think that in this very widespread product market reforms, because that covers a lot of very different issues, from time to time here and there are a lot of vested interests that are very efficient and that make these reforms not happening. And that I really see across. It's not Sweden against Greece or Germany against Spain. I see that happening in most of the countries, and this is really an issue that we need to address. And I think it's even more important in the current times, and I link that also with the inequalities, or at least the perception of inequalities, that there is a strong perception that some groups have suffered from the labor market reforms, while others that are still kind of living through the privileges because no product market reforms. And this might be partly true, it might be partly a perception, but that make also sometimes the reforms more difficult, this sort of perception. So we think that product market should also be pushed forward. Another element that we think it's very important on the fiscal, and I will end with that one, is that yes, we focus a lot on the fiscal balance, fiscal stance, let's say, but it's even more important to focus on the composition of the public budget. So for us, it's not so, I mean, from my point of view, it's not so important to talk about 34 versus 42% of budget or whatever, but it's more about the composition. And there I think that there is a lot of margin. And that goes for the different policies that are supported by the budget, but also the efficiency of these policies, and that applies both to the taxation side and to the expenditure side. Thank you.
Thank you. I think if there is one common theme emerging from this, it is that a lot has been done and much more could be done, and I would like to pick up on that particular theme and ask you, Alina, about what you think the obstacles really are for the European institutions to do more. And to my mind, one obvious obstacle has to do with politics. Europeans are fairly comfortable delegating arcane technical policies to European institutions, but when it comes to important reforms that would either complete the single market in services or bring the needed flexibility to the monetary union, there is always a lot of pushback against solutions that are seemingly coming from Brussels. And we remember what happened to the Bolkestein directive, and I wonder if European institutions can do better than just muddle through these seemingly unsatisfying compromises, whether we would need to fix the politics first, or whether this is the best of the possible worlds.
I wish to have the answer to that. This is the big question, because it goes very much to the institutional and political. I think that there are three levels of response. One is, for sure, with the current setup, some things could be done better in terms of, let's say, policy preparation, policy design, maybe preparing ex ante with the various partners, including member states, and in most cases the European Parliament, that are those that have to take the final decision, to build up the design with them to make sure that the final decision will come and will be the closest possible to the optimum, let's say, or the first best. That's one thing. Second is about competences. If you ask me about are the current setup of competences between national countries and EU level the best one, probably not. That we could discuss longer about which things should be, but because I think that maybe some things should go back to member states and others should go up to the European level. So there is, I think, for sure, a discussion to be done there. When is the right time? That's another matter, because always the risk is that instead of moving forward, you move backwards when you start this kind of discussion. So yeah, and the third one is say that all this decision making, that it is majority. A lot of changes were done in the past in the treaty to put majority decision in certain areas, but others are still consensual. And even for those that are majority, there is a sort of wish to move by consensus, which personally I think that with the current setup and the type of member state we have, is very difficult to move forward anything by trying to get everybody agree on everything. But that means another type of political setup. But still, I don't think that the status quo is bad and will remain bad. I think that there is a lot of improvement that can be done even with the current institution. My personal view, really personal, is that we should try to improve what we can improve and not be blocked, let's say, by the institutional, because the institutional, the political setup will not change in the next 3 months, and maybe it's not the right battle for the immediate future. But that's really my personal opinion.
So I know that Anders and Carolina were aching to add something to that. Anders, you wrote an iconoclastic article a few weeks ago on how the post-2008 response of European countries, individually and collectively, to the debt crisis could be characterized as economic populism. So could you please expand on that and perhaps even react to what's been said previously?
Indeed, you've got it right. I completely agree that the problem is not institutional at all. The problem is no sense of crisis. What happened after the global financial crisis, that was that everybody, national governments or the ECB, poured money on everything. As a result, there was no real sense of crisis. It's very different from what happened in the early 90s in Sweden. The dean of Swedish economists, Assar Lindbeck, chaired a big report, and when he presented it, he reported that one of the journalists asking, "Will Sweden survive?" That was the sense that Sweden could go under. We could see during the Greek crisis that was far more serious. The question was, or the demand was, that Berlin, Brussels and Frankfurt should do much more. It was not a question of can Greece survive. So that the European Union functioned too much as a saving boy for the countries in crisis, so that they did not have to change. Greece still has the highest public pension expenditures by far in Europe, closely followed by Italy. But this is too little reform when it was really needed, because they could rely upon the European Union to too much an extent. That's what I mean by populism.
No, I just wanted to say that I think when it comes to structural reforms, and given that many of these areas are really the competencies of the member states, I mean, there has to be some sort of national ownership in order for this to be implemented in some reasonable way. I think, I mean, Greece is a good example because they've had all these emergency loans and with conditionality. I mean, they have been pushed to carry out reforms, so they've sort of pushed legislation through parliament. But if there's no ownership, I mean, it's not really going to change very much on the ground. And I think that's the difference. Like in Sweden in the early 1990s, there was a sense that, oh, well, now we created this mess and we have to try to dig us out of this hole. And then there was, I mean, the whole society seemed to stand behind what the politicians then put forward to the electorate, and there was even broad agreement across the political spectrum about how to proceed, and with quite difficult types of reforms. Now, I interpreted your question as saying, well, it was sort of suggesting that maybe you could push this through if you maybe transferred some competence to the EU level. But I think that would be quite dangerous at the current juncture. I think that's exactly the wrong way to go, because there is this sense that it has impacted negatively on sovereignty in a certain way. So, I mean, I would expect the way forward now to be, not more centralization, but to try to bring the member states together and have more of a shared ownership of what it is that we want to achieve together as a union.
I just wanted to add one point to, I think, Elena's very important one that I meant to bring up as well, which is on convergence. Because I think in Europe, and when we talk about Europe's prospects, I think in general, but also from a financial market perspective, I think the primary concern is not about Europe as a whole, but it's about the differentials within Europe. So ultimately, I think whatever setup we choose, whether that's at the EU level or for national governments, it needs to be, in the light of all these political uncertainties, it needs to be that the European setup is an engine for convergence, for economic convergence. Because I think that's the critical difference to the US. In the US, we don't doubt the institutional setup as a whole. I mean, I know recently there have been some discussions, but overall, I think the reason that or the fact that Appalachia is lagging behind so badly and for such a persistent period of time doesn't existentially threaten the structure of the economy and to some degree even of the politics in Europe, it does directly enter the risk premium. And that therefore makes it much more important to create a setup that really works towards economic convergence. And the European Union, of course, had been a major engine for economic convergence for long periods of time. More recently, it's kind of followed offsetting or had offsetting effects. There are, of course, areas where there were buffers that being in Europe and being part of a currency union also created. But then there are aspects of the framework that probably were actually hindering, if anything, the weaker countries. And I think many of these are at the macro level rather than the micro level, but probably even at the micro level, I think the imperative has to be how do we make sure that the divergences within Europe don't widen even further and therefore threaten, I think, the prospects for sort of a durable recovery even more.
Great. I think it's now time to bring the audience in. You haven't been forgotten. So if you have a question, please raise your hand. Robert Barrow, please wait for the microphone. It's coming.
I was struck by Anders' observation that Swedish government expenditure relative to GDP had fallen by more than 20 percentage points over the last 2-3 decades. I would love to learn a little more about the composition of those cuts in terms of what programs were particularly reduced or eliminated over that time frame.
Let's take actually a few of these questions at a time. So, the gentleman on the left, please.
Chris Bledowski from Manufacturers Alliance for Productivity and Innovation. I have a question for Anders that kind of ricochets off what Ebrahim has just said. You mentioned the 1 percentage point growth that could be gained from the structural reforms. I suspect that this would come in the growth accounting exercise as a solo residual, so outside of plain capital and labor. But what about labor? Does any of the reforms that you suggested would alleviate the high percentage of the labor force that is unemployed for a very long period of time? In other words, reabsorb those who have been out of work for a very long time, so give a kick also on the supply of labor? Because that seems to be a quintessentially European problem.
Okay, let's do these two.
Yeah, first, Robert, the cut was essentially on social benefits. A big chunk is Sweden has very generous unemployment benefits. When unemployment falls back, disappears. Then changing the social benefit systems so that you did not get, say, 100% coverage when you were sick, but 80%, and you don't get it from the first day. And all of a sudden, Swedes were sick half as much as before, which was an additional benefit. So you might know the number, but I think that 2/3 of the cut was social benefits. So the social benefits have simply risen out of all proportion. And then at the same time, you get a substantial improvement. On the side, what increased the growth? That, according to McKinsey Global Institute, was primarily the deregulation of the retail market. The retail market in Sweden used to be extremely regulated, with 3 oligopolistic groceries being in every city, having the prime places. And now you have German discounters, you have shops open in many places all around the clock, and that also gives a lot of extra jobs. And Chris's question about
1 percentage point extra kick to the...
Oh yes, I looked up on the numbers, and you have a very funny structure on the labor market in Europe. You have some countries where many people work. Sweden is an extreme example on that. You have countries where few people work. Greece is the extreme example on that. And then you turn it around and check how many hours do they work. The Greeks work the most hours, Swedes the least hours. So you can see this is the impact in Sweden of high marginal income taxes, in Greece of a very severe labor market regulation, so that employers want to give their workers overtime. Overall, the effect would be, in comparison with the US, 9% more labor if you take both effects. So this is almost half the difference in GDP between the US and Europe. And it's not old. If you look upon France, I think until 1970, the French workers and the American workers worked an equal number of hours. So it's a recent phenomenon coming out of labor market regulation that have diverged between the US and most European countries, and higher marginal income taxes in Europe that essentially started around, the difference started around 1970.
May I just to Robert about the experience in Sweden? I mean, there is actually some sort of pamphlet or paper by one of my predecessors, who was a state secretary at the time when the consolidation was carried out in Sweden. His name is Jens Henriksson, and he explains sort of the thinking behind what they did. And actually, it was quite crude, and so they thought that, well, we're just going to do half of the consolidation by cutting expenditure, half by increasing tax revenues, and it was quite broad. I mean, there were also cuts in universities, education, healthcare, childcare, the public sector, also the services that it provides. There were significant cuts. So it was broad and not, I don't think it was very sophisticated. But it had to be done, and everyone sort of rallied behind it. I was also going to say about when it comes to labor markets. So one reason, of course, when you compare labor markets in different countries, one aspect that you need to take into account is women's labor market participation. So, one reason why average working hours is fairly low when you look at the whole working force in Sweden is because we have a very high labor market participation rate for women, but a lot of them actually work part-time or with reduced hours.
Does anybody have a very concise final question? Yes, please.
Thank you. Hans-Roger VB. The question is for Monsieur Rabari. In reference to the risk premia, is it a function of low bond yields, or do we have a methodology which allows us to quantitatively distinguish what causes the spread, for example, between the French 10-year and the German Bund?
There's no sort of, convincing science behind estimating some of these risk premia. So what many people do, and my colleagues and I are no exception, is you essentially you use a number of different approaches and kind of average between them. And what you tend to find is that the fit isn't constant over time, but that you did get a good. What we did, for instance, when it comes to these differentials between Europe and the US, that there was a reasonably good correspondence between measures that reflected real activity, like differentials between PMIs or real growth, but then specific financial stress variables as well, like sovereign spreads, sort of specific financial market stress variables as well, some spreads in the sort of interbanking sector. And when you look at these things, they tend to now have worked less well over the last, let's say, 18 months or so. So that's, partly in that period, of course, economic differentials narrowed. In fact, Europe has on occasion grown faster than the US has. Many of these financial stress variables have narrowed significantly as well, but these overall differences in equity valuations haven't. And that's why I said I think it's mostly a measure of ignorance. But when you think through plausible candidates, I suspect political uncertainties are probably a relevant one.
That brings this session to a close. Please allow me to thank our participants, our panelists. There are refreshments served outside, and I think we will reconvene here at 11 for a session chaired by my learned friend Stan Beuger. Thank you. Thanks, Anders.
Thank you very much.
All right. I think my mic is working.
Sounds good.
Good. Welcome back. This is our second and final panel. We will discuss macroeconomic policy after covering microeconomic policy in the first panel. As Mike said earlier, that covers all policies. This panel, I'm going to try and, make it flow smoothly while carefully moderating. We're going to talk about macroeconomic policy in the European Union, but we'll discuss U.S. policy as well. What we think of, what's the Trump administration going to do? What's the Fed going to do? How are those things going to affect Europe and its policy mix? I'm going to skip long introductions. We have Robert Barrow, professor at Harvard and visiting AEI this year. Joining us, we have Servaas de Roze of the European Commission, Angelo Bide of Goldman Sachs, and Kevin Warsh of the Hoover Institution. I'm going to ask Robert to open our panel discussion, and then we'll see where we go. Robert, you want to set the stage for us?
I'll do my best.
Thank you.
So one consequence of my visiting at AEI this year is that I've spent more time thinking and writing about current economic policy areas. And as a consequence of that, I was actually invited to be on the O'Reilly program.
Last episode.
Which at the time was the highest rated cable program. And a few days after I was invited, he was fired. And I'm pretty sure that wasn't the causation, but I'm a little worried about that. But anyway, I never actually did appear on the program, so it wasn't the last one. A few thoughts about the likely package of economic policies from the Trump administration. It's pretty clear that it's going to be some sort of fiscal package, and it will undoubtedly include substantial cuts in the corporate profits tax, possibly cuts in individual marginal income tax rates, along with further base broadening, which would be reminiscent of the Reagan 1986 tax package. It would be great if it included aspects of entitlement reform, but I think that seems like a lower probability item. I think there will be advances on regulatory reform, particularly aimed at things involving energy, environment, financial sector. And I think that these reforms could contribute to higher economic growth. There may be a substantial infrastructure investment program, particularly aimed at transportation. That could be positive in terms of a high rate of return set of activities, but it's of a concern from a fiscal deficit standpoint. The biggest concerns relate to international trade, protectionism, including the recent Buy American rant that was around yesterday, the day before. I think it's likely that some kind of border adjustment tax will be part of this picture. And I have this kind of cynical perspective that a border adjustment levy might be a good idea because it's basically harmless from an economic perspective and might allow President Trump to say he's being protectionist because he's taxing imports, and therefore be ostensibly protectionist in a way that's not actually so harmful. But from a public finance standpoint, a value-added tax, or VAT, would certainly be much better than a BAT, border adjustment tax. The biggest problem with a VAT is it makes it too easy for the government to raise a lot of revenue and therefore grow larger. Given the prospective problems in terms of protectionism, one would have thought that there'd be more fear in financial markets related to that, because there's a lot of uncertainty about what will happen, and some of the outcomes look like they could be bad. But if you look directly at financial markets in terms of the extent of the fear, inferred in particular from things like prices of far out of the money put options, which you can use to get some gauge of the extent to which disaster events are probable, it's surprisingly tranquil in terms of what those numbers look like. It doesn't look like the markets think that there's a high chance of a bad outcome, disaster event associated with the economic policies. I'm not sure why the financial markets are so confident in that regard. One other thing I took as a positive was Trump's recent announcement of Kevin Hassett as the chair of the Council of Economic Advisors. I think Kevin is a great choice. He's a very solid public finance economist, not like some of the economic people with whom Trump has consulted. So I thought that was a great sign. I mean, we don't know yet whether the council will be important as an influence on the administration's policies, but choosing a solid economist like that I thought was a positive result.
Nice. Kevin, do you agree with the predictions of the policy package as delivered here, the likelihood of relatively comprehensive tax reform, border adjustment, things like that?
So I think it's a pretty complicated set of issues, so I'd try to take them on one at a time. What I'd say, I guess, at the outset is it's about time we try some pro-growth policy. Both to our European friends and to us in the US, we have been engaging for most of the last decade, preoccupied with filling aggregate demand by all means necessary. And I think the results prove that the preoccupation with demand to the neglect of supply-oriented policies have been quite destructive to economic growth. I mean, the reason that Bob and the rest of us care about growth is it fundamentally changes human welfare. I, for one, am not sort of taken in by the secular stagnationist crowd that have said, well, these policies are as good as can be done, and 2% growth is the best the US can do. In fact, when I look around at the folks in this room and think about the European perspective, this will now be, I think, the 5th quarter in a row, the first quarter of this year, where Europe has actually grown faster than we did in the US. And if you think about the lack of structural reforms in Europe, you'd say, my goodness, certainly our potential is higher. So I think the kinds of policies that were described, many of them have huge opportunities to make economic growth materially higher. Now, where politics and economics meet will be the difficult point. I guess I'd say a few positive things. Rhetoric notwithstanding, the trade agenda to me looks like it is much more on course than most people would have us believe. My judgment is that there are very positive outcomes that can come from a reform NAFTA, and we could well be on the path of that. Taking up a bilateral investment treaty with Japan, I think, has huge promise. Is it perfect? Perhaps not, but I think the administration has shown some real signal there. And while this is the first of the meeting with the Chinese, if you get the G2 relationship right, that's very good for the G20. You get the G2 relationship wrong, where we're talking zero-sum economics, I think it's deeply destructive and tells the other G18 that protection is to come. So I think the trade agenda can really be growth-oriented, and we'll see if it ends up being it, but I'm more optimistic than most. On the regulatory side, to Bob's point, these supply-oriented changes on the regulatory front, they take a while to find their way into the real economy. They can find their way into animal spirits, but I think they take a while to find their way in the real economy. So that's 18 months, broadly speaking, before we see potential supply moving. But I'm quite encouraged, and I think they can come perhaps faster outside of financial services than inside. Maybe I'll just end with a final point on tax policy. Radical fundamental tax reform is essential to higher growth. I don't know whether 2017 will be that year. If it isn't, I'm afraid it will be an opportunity squandered. Many of us in this room might talk about benefits of marginal rate reductions. I'd certainly put myself in that camp. But the supply side effects that would come from fundamentally throwing away 2/3 of the tax code, letting capital find its way to its highest best use, this really can dramatically change the course of the next 10 or 15 years. So whether this is a year of tax cuts or tax reform, I'm truly not sure. But those are just a few thoughts, and I think the truth is the US should be, parochial American view, should be leading the world on what pro-growth policies are about. We haven't for a couple of administrations, and it's high time that we do. If we do, I think there would be plenty of followers. These policies are not zero-sum, they're positive-sum. And I think if I look at the growth rates in Europe, which have been better than ours now for a year and a half, Imagine if they and we adopted these supply side reforms. It would create room for central banks, it would change the supply side of the economy, and it would actually make it so that our electorates are a bit more happy as well.
So do you see prospect of a trade agreement with the UK? You mentioned Japan. I was wondering what you thought about the UK.
Yeah, so I do see prospects. Obviously, the UK is somewhat hamstrung in their ability to have a formal trade negotiation. But if it were up to me, and it's not, I would be engaging informally and as appropriately with the UK in agreements that would be good for Britain and good for the US. Would that give the UK somewhat more negotiating leverage in some sense in their discussions with Brussels? You bet. But again, I'm not the one who thinks that competition in this is a race to the bottom. I think competition's a race to the top. But again, if I think about UK-US, Japan-US, China-US, Mexico-US, I'm not as dour as most people are. You might see targeted cases that come from the Commerce Department and others for dumping on certain products, even certain industries, and we can have a good family fight about whether they're good or not. But we got to keep our focus on magnitudes, and the magnitudes of the good stuff I think can be quite promising.
No EU, US?
I think it's difficult. I think there's a bandwidth constraint both in the US and in Europe. So I think it should be on the agenda, but I think the trade agenda that I outlined is quite a bit more aggressive than is the consensus in Washington. And if we could get those four on the right track in ways that is good for American growth, American workers, capital investment, capital deepening, productivity, then I want there to be a big Q behind it, because people want to sign up to be with a U.S. economy that is open to the world. And my own judgment is that most of the rest of the world still does want to invest actual capital in real assets in the U.S. The tragedy of the last 10 years or so is there has been an incredible amount of investment in the U.S., and it's been in financial assets. It hasn't been in real assets. This explains, in my view, why financial markets have done so well. Explains why the real economy, property, plant, equipment, software, is anachronistically poor.
I want to give Savas the chance to explain why, despite what Kevin referred to as limited, say, structural reform on the supply side, why Europe is growing faster than America. What are the successes attained? How do you see the economy of the European Union evolve in the next few years?
So I would have reacted as well to the others, but I will do that later on, and what Trump implies for us. But certainly in the euro area we are witnessing what I would call a brightening economic outlook, with growth, as Kevin has indicated, close to 2% over the last quarters, and also quite likely to maintain that momentum, if not increasing it going forward. So around 2% 2017 and 18 seems to be just a consensus view on growth in Europe. So where does it come from? I guess it's no longer the case that growth in Europe is essentially driven by what was called exogenous favorable tailwinds in terms of low commodity prices, low oil prices, or even a low exchange rate. So that has helped in earlier phases of the recovery, but these are no longer driving forces. The driving forces are in principle twofold. One is much improved fundamentals in Europe, and the second one is an increasingly supportive macroeconomic policy stance. So if I have a couple of minutes, I would elaborate a little bit on these issues. So the fundamentals, what we see in Europe is that first we see a very positive circle developing between private consumption, labor markets, and then raising disposable income, feeding gradually into investment. What we have seen in this recovery is that the employment reaction to growth has been much stronger than ever before. So the job richness of growth is quite astonishing, which certainly is testimony of the labor market reforms that many member states have undertaken over the last 5 to 10 years, so which gradually start to bear fruit. And so this private consumption So it's domestic driven, it's no longer external. It's certainly one of the major factors for growth going forward. A second issue that we see is that the banking sector, while still being faced with a number of problems, so profitability is still low for quite a number of reasons, over banking and sector high cost. But we also see that the banking sector has improved a lot. Supervisory and regulatory systems have been overhauled, and these also gradually start feeding into improved bank intermediation in Europe. What we see is credit growth is now becoming positive again for quite some time already. But we also see, and it has been discussed a little bit this morning, non-performing loans were certainly still a major issue in a number of countries. But we see in many countries, and certainly those who are most affected by this, quite an important decline in non-performing loans on an annual basis. And there is further improvement in a number of countries in the next weeks to come, which will certainly underline that non-performing loans will be reduced, and so will create further scope for the banking sector. You may also have read what ministers have discussed at the informal ECOFIN in Malta on NPL strategy, where there is now a well-developed strategy being elaborated by the ministers, which would involve improved insolvency frameworks, strengthening secondary markets for NPLs, and also blueprints for asset management companies. And all this within the current system that we have in Europe. So if that is getting ground, I would think that over time we would still see even stronger growth. A third element is that in Europe, following the crisis, there was certainly a huge debt overhang in the private sector, both households and corporate sector. What we see now in the early years of the recovery, the debt deleveraging that took place was of the negative sort, so to speak. It was debt deleveraging in the private sector through cuts in credit, so negative credit growth, which even did not do much in terms of reducing the debt. What we see now is that at last nominal growth has been strong enough so that you can move from a balance sheet deleveraging into a macro deleveraging process, which is the positive sort and which is self-feeding into the system. Last point that I would indicate on fundamentals is that has been discussed to some extent in the previous round. Competitiveness, which was really one of the major problems in many countries going into the crisis, which was one of the major causes of imbalances in many of the European countries. Competitiveness has been improved quite a lot. And it's not only about cost competitiveness, but also what we call the competitiveness in terms of products, technology, the type of products that you export. And here, R&Ds and so on. All that has strengthened a lot, and we can see that even despite a very weak global environment, the export performance of European countries is still strong. So that means that all these factors has come together now and seems to lead to, I would still call it essentially a cyclical rebound, and the next challenge is to transform that into a medium-term, very strong growth. Then the role of macroeconomic policies, and I presume Angel may say a lot about monetary policy, so I will be relatively short about this. But monetary policy in Europe has certainly been at the center of the recovery that we have seen over the last two years. There has been a lot of debate, there has been a lot of quite controversial, the quantitative easing and the different asset purchase programs of the ECB, but they are working and they contribute enormously both to growth and to put headline inflation at least higher up. Core inflation is still lagging, but that's also still coming. And I presume that this supportive monetary policy will be there for the near future, or even more than the near future, given that the inflation criteria that has been exemplified and pressed by the ECB, the 4 criteria, which means inflation close to 2%, inflation should be durable above 2%, it should be self-sustained, so without QE, and it should be for the euro area. So these 4 criteria are far from being met, and so I presume that we will see quite a continued support on the monetary side, even if some unwinding will come at a later stage, but it's not immediate in my view. And what we see now is that what has been asked for quite some time, that monetary policy was overburdened for quite some time. Now we see that fiscal policy is increasingly supporting the monetary side. Well, fiscal consolidation of 1 to 2% over the period 2012, 13, 14 was really hampering the recovery. We got 2 years of broadly neutral fiscal stance, and now we may even gradually move in a neutral to slightly supportive fiscal stance in Europe as a whole. We have advocated a 0.5 support for on the fiscal side, not so much because there are still uncertainties about the output gaps, about the investment gaps, but certainly to support monetary policy and to get a much stronger recovery on a much solid basis. I will stop here, but I can.
I see. I think it makes sense to next turn to Angel. Can you talk both about how you see this mix of fiscal and monetary policies, what you think? I'd like to hear why you think that, especially the monetary stance, changed. Why it took a while for the monetary stance to become more accommodating. How you see the complementarity with fiscal policy going forward, and then maybe also sort of the private sector view of how likely is it that the medium term improvements in fundamentals that Savas talked about will actually materialize. So, that's a lot of homework, but you know.
So no, I want to stress the point that Savas says about a better policy mix, because I think there has been a lot of debate whether the euro has been a failure, and I think that's asking the wrong question. I think the question to ask is, have policies been right or wrong given the euro? And what we see when we look at the data is that the euro area and the European Union both, but the euro area in particular, were doing similarly well or badly as compared to the US when you look in per capita terms. And then a spread opens after 2011. So something happens around 2011 and 12, and what happens is a very sharp tightening of monetary and financial policies. That was reversed in 2014-15, and what we are seeing is the fruits of that. And so the euro area recovery is young. It's 3 years old, essentially. So there is a bigger output gap. So no wonder that it's also growing more than the US. There is more output gap that needs to be filled. But finally, policies are in the right place, also in the direction of ruling out bad outcomes. So there was a lot of worries about euro breakup and everything else. Now that has been diminished. Even if, and I think that's a source of upside risk that Servas hasn't mentioned, the equity risk premium in European assets still remains very high, at least compared to the risk-free rate. And so as we clear some of these hurdles, you know, for example, after this weekend and the next few weeks with the French election, I would expect that if the outcome is positive, then that risk premium would come out and it would contribute to further reducing the cost of capital and boosting investment. So there is a good chance that you get into a virtuous circle of essentially more demand feeding into more investment and then feeding into even better potential growth. One of the stories that I think have not been highlighted enough about Europe is the amount of reforms that have taken place in some of these countries. Not in Germany, because Germany hasn't done a reform that is worth its name for probably a decade. When you look at you know, not just Spain, Italy, Portugal, Ireland, take France. The fact that people went on the street complaining about the labor market reform, even if it's not extraordinary for France, it does mean that it had some teeth. So there has been action. Potential growth is probably higher than many people estimate, and we will only know that ex post. But the proof is that inflation is not really picking up, despite you know, a couple of years of above potential growth. And I think that what needs to happen in Europe is a continuation of this, a continuation of the good policies. And if they persevere on that, then they need to move to the next step, that is to make the euro area sustainable in a structural sense. And that requires an extra step of moving towards a European fiscal policy, euro bonds, and other things.
Do you think those things are feasible?
If we get the right outcome in the French and German elections, I think the probability increases. The Commission, I understand, will publish some options on what can be done and different avenues of how you can move forward in the different areas of, you know, as they call risk sharing, risk reducing, and fiscal stabilization mechanism and all that. I hope it happens. I think the chances improve with some of the outcomes in these two elections.
So on the French election, and also on this goes back to what Robert was saying. Do you agree with Robert that there is a number of sort of tail risks, both on the trade protectionism side and in some of the upcoming elections, that markets are underestimating, or do you not think that that's the case? Do you think that's why you see increased equity risk premia?
there is a lot of hedging activity.
Yeah.
I mean, one thing I would like to mention, responding to Bob before, is that in the US equity market, for example, a lot of the activity related to Trump's policies and risks has happened at the micro level. So essentially what you have seen is a sharp decline in the correlation of the individual stocks inside the S&P 500, for example. So the policies, the risk of these different policies happening was being priced at the micro level, at the individual stock level. But then at the aggregate level, growth outlook was okay. And since a lot of these potential events are not going to happen still for several months, hedging is costly, and that is why you don't see it that much, for example, in the VIX. So there is a sort of two different levels where the hedging for these activities is happening. In the European...
That's a little surprising, because you would have thought some of these bad macro policies that people have worried about, or trade policies, you would expect those to have macro implications.
So in the case of trade policies, you could see it on the Mexican peso, which has been the favorite asset for markets to hedge a trade war, if you want. But in others, like the border adjustment tax or some of the other actions, anything may not happen for still another year. And so you don't want to be hedging now for that kind of event.
If you thought something terrible was going to happen 12 months from now, you think it wouldn't matter for today's asset prices?
Little. If I know with certainty it's only happening in 12 months' time.
Wow.
Well, there is
we can't help but notice the troubling myopia that would suggest about risk assets.
I'm explaining how it works. I'm not saying that I'm endorsing that, but I'm explaining a little bit how it works.
I mean, I've constructed a kind of disaster probability, like a time series, which is related to the VIX. It's not really independent, but it's, I think, a cleaner measure. So that peaked dramatically in 2009. You know, at something like 40% probability of something really terrible. And then it declined a lot and then fluctuated a bit, but now it's like 5% instead of 40%.
Yeah.
So that's what I don't know how to mesh with this concern about crazy policies. And I can't believe that if the crazy policies didn't come for 12 months, that it wouldn't be a worry today. I don't
probably part of the hedging that you have in mind is what's keeping long-term interest rates low. So you could see that it happens at the asset allocation level. So rather than increasing your allocation to equities and decreasing the allocation to bonds, you keep your allocation to bonds a little bit higher because they would hedge you in case of something like that happening. But markets have trouble dealing with events that are undefined both in shape and in time. Right?
So just to add a word to that, Stan, I can't think that markets have been this pleased with themselves since, I don't know, spring of 2007. This doesn't suggest that, the next crisis is there, but maybe we should just say a word here on free lunches. So it's hard to find them in economics, though in trade and other things we can see win-win outcomes. I mean, at core, monetary policy can bring forward demand. At core, monetary policy can make the next quarter and the next year better than it otherwise would. But few of us who take this seriously think that we can fundamentally change outcomes over the long-term horizon. So if you gave my view of what markets are experiencing, I would say, well, markets have come to believe, and this generation of traders have come to believe, that asset prices make complete sense if we're going to have negative real rates for the rest of the cycle. And markets have come to believe that if asset prices would fall, that we central bankers will be there to clean up the mess and ensure that prices grow to the sky forever. When I look at VIX measures, other volatility measures across equity markets, bond markets, I know markets quite pleased by these. Central bankers should not be pleased at all. Risks are highest when measures of them in markets are lowest. What it tells me is that the markets do not have a shock-absorbing capability for things that none of us can properly envision. And it is foolish for central bankers to think that their dots of their forecasts have a degree of conviction that they should be betting our economic futures upon. So if markets aren't focused on tail risks, we central bankers better darn do the same. Normally, between crises, we've had opportunities to normalize policy, to get back to equilibrium real interest rates that bear some resemblance to history. So while markets might be complacent, I think central bankers should be worried that the thing that is most likely to take them far away from their vaunted inflation targets and their diminishing output gaps are shocks. Financial stability risks are greater risks than whether core headline inflation prices are up a tenth or two, which seems to be the preoccupation of a group of people that have quite a bit more authority than the likes of us.
And so what do you
think?
Let
me say, in the U.S. context, particularly since 2010, the striking pattern is that the labor market has been quite strong and has shown at least a normal kind of recovery in terms of unemployment, in terms of employment growth, at the same time that GDP growth has been anemic. So the other side of that, which is really the same thing, is that productivity growth has been essentially zero since 2010. So if I think about that in terms of policy, I have to think about policies that might boost productivity growth. And that's why I don't put at the centerpiece monetary and fiscal policy, which I don't think in terms of kind of supply side elements that would matter for productivity. That's why my focus, particularly in the current environment, at least in the US, is not monetary and fiscal policy. It's more about things like regulation, maybe tax reform, perhaps infrastructure investment, those kinds of things. I can understand about how because they'll feed into the productivity problem.
But these are two separate debates to some extent, right? One is a discussion of ongoing attempts to increase potential GDP. The other one is how to manage tail risks. And I think that those are separate issues.
Tail risk is another real thing. So that's kind of related to productivity, but it has a different kind of timing dimension in terms of may or may not materialize. It has some impacts on investment and other factors, but it's certainly a real phenomenon.
For sure. But what I think Kevin was hinting at is that you may be able to increase productivity by 0.2% a year, but if there's going to be a 5% GDP shock, you want to have that 0.2% is not going to help you deal with the fallout from that.
Right.
And the sense I was getting is that you're saying central banks should be biased toward raising rates and phasing out whatever unconventional programs they have going on to be ready for a shock. Is that a correct interpretation?
So I'd say first, just to tie Robert's comments to mine together, good policy has good outcomes. Good policy mitigates risks of financial shocks and strengthens your ability to respond. Good policy drives productivity, which would drive wages. A colleague of yours here at AAEI has been known to call the period since 2000 America's second Gilded Age, because for those that are in and around financial assets, I mean, what could possibly be better than this? But of course, if you are like 52% of our fellow Americans and you don't have financial assets, well, the Gilded Age hasn't been quite so gilded, and that's really to the point that was made earlier. Well, that's because of wages and productivity gains. So I put myself in the Barrow camp and suggest that good policy is good policy. Now, the implications for central bankers are that we have not come up with a free lunch, and we shouldn't leave the impression that we have. We shouldn't be leaving the impression that we are fundamentally favoring financial assets over risk assets, because when we do, we find that when the shock comes, that the real economy doesn't have strength, and financial assets might not be at an equilibrium rate. So those are the challenges. To your particular question about what are the implications for monetary policy, listen, we can get into a proper discussion about hawks and doves, but I would say this. The reason why central bank actions have been so forceful and in the minds of the financial market so effective in this period is because when the Bernanke Fed took over, we inherited a lot of credibility from our predecessors, Chairman Volcker and others. So there will be another shock. I don't know when it'll be. But the central bank needs to leave for its successors credibility. Credibility comes from symmetry in policy. going into shocks and coming out of them, and we shouldn't leave the impression with anybody that there are free lunches because we're going to keep negative real rates the world over, and that how somehow we have forgotten that in every textbook. Because if that is true, that there is a free lunch and it involves singularly free money, which can compensate for the failings of broken fiscal policy and trade policy and the rest, well, then we really need to revisit what we're teaching in Econ 1, because what we teach in Econ 1 is there's this thing called supply and there's this thing called demand, and they have to cross. My argument is we've been preoccupied with one of those to the exclusion of the other.
Is it called Econ 1 at Stanford instead of 101?
Yeah, it's called Econ 1 there, and at Harvard Ec 10, so I don't know who's got
10
it
is
right.
a higher number.
You know, I think negative, basically safe real asset rates is a very different thing from what the required return on capital is or what the expected return on equity is. And those rates are nothing like zero or negative. Those rates are substantial, and there isn't really evidence that the equity premium has gone down. Probably the opposite. So I think that in some respects there's too much focus on like T-bill rates and what they imply about safe real rates. And I think the fact that safe real rates are low is a sign that things are problematic, actually.
So fast that you,
I want to interfere with us more about Bob's comment on, I would worry more about supply than demand. But I understand that's related to the US situation. I would not generalize this for the European situation. Because in Europe, what we see is that, and there is an interaction between demand and supply in the sense that if you have a long period of insufficient demand and wide output gaps, you get hysteresis effects in your markets, labor markets, but also in investment. And so if you don't bring forward your demand, then you also affect your long-term supply. And so that's what one should not lose sight of. And that's why I guess it's so important in Europe that the macro side is now in a better shape than it was before.
How do you think that will remain the case going forward? Do you think that Europe is still at risk of, say, in the next downturn, coming up with the same policy mix that it imposed between, say, 11 and 14? Do you think that there are institutions in place now that would produce different policies?
The situation in 10-12 was, in my view, highly exceptional. And so if you would have a normal downturn, I would not see the need for such a drastic adjustment. You refer certainly to the fiscal austerity that people refer to, but to a large extent that was compelled by market forces. So many member states were losing access to the markets. And so from that perspective, the markets, rightly or wrongly, but they requested fiscal consolidation in quite a number of member states, much more than potentially was sustainable and was good for domestic demand. Once this market frenzy was coming down and calmed down, then we have seen that the pace of fiscal consolidation has come down quite a lot. In some countries we had fiscal consolidation of 2-3% on an annual basis. Now we are speaking about, for those countries which have fiscal imbalances, of an adjustment of maximum 0.5, which is not really hampering the economy, but brings your fiscal situation gradually online and starts creating, not yet, but in the future, the buffers, what Kevin from the monetary side was referring to. We should not lose sight of this neither, so we should prepare for the future and for the future downturn. And so prudent fiscal policies and, where necessary, further consolidation on a very gradual pace is important to build fiscal buffers in case the downturn strikes again. So to avoid that markets again would be faced with too high increases in deficits and debt in Europe. So that's important.
Buffers everywhere.
I had a question for Kevin. You mentioned reform of NAFTA, NAFTA with respect to Mexico, and I wonder if you had some details in mind about what reforms seem to be useful and potentially realistic.
Yeah, so I'm not privy to the discussion, but my suspicion is that one way in which the agreement could be made popular and successful on both sides of the Rio Grande would suggest that you'd change the percentages of origin rules that would bind these two countries. So for example, if one believed that inputs were coming into Mexico that were dumped below cost or somehow otherwise subsidized and were deeply troubled by that, and that was a backdoor way which these non-NAFTA goods find their way into the free trade agreement, then what you might say as part of a negotiation with Mexico is if the commodities and products and inputs are truly Mexican or American or Canadian, then we will let them and abide by the preferential rules within NAFTA, but they have to have been born in Mexico. So if you were a political figure in Mexico and the car assembly really had goods only from the three countries and not from the Far East, and that would be good for Mexican employment, good for Mexican production, might lead to higher costs for the ultimate final good, then that is subject to this preferred arrangement here in this hemisphere. So I could see higher percentages that must come from the originating country in Mexico in order to sort of find its way into the US at preferred status. For Mexico, that could be perceived to be good for employment and growth. For the US, it could suggest there's not some circumvention of the original intent of NAFTA. That's one of, I think, a number of ideas that are likely to get some traction over the course of the next 6 or 9 months.
I never really understand dumping.
It's when people give you really cheap things.
If the Chinese want to give us stuff for free, I don't know why that's bad. I've always had a lot of problems with that.
Yes.
And that seems to be what you're talking about here.
Yeah, so I have some sympathy with you on the nature of where the subsidies come from. But if you asked me to tell a reasonably benign story relative to rhetoric of where NAFTA might go, it might be a deeper integrated supply chain between and among these three countries as opposed to a bridge to a foreign supply chain. US consumers in that circumstance where the dumped products don't find their way in might not be as pleased as the elected leaders in cutting that agreement. But last thing I'd say about this, these kinds of reforms broadly around trade is fundamentally about industry structure and about changes in global supply chains. They do not happen overnight. These are very complex. And so even if ultimately we end up with a integrated set of trade agreements that bridge parts of the world, that increase the economic pie for the US for exports and purposes of imports, this is a slow process to get there. So I wouldn't be changing my potential growth figures in 2018 because of even all of my optimism about Japan, Britain, Mexico, and China. But I think that's a far better story than the story which I keep reading about, which is the US is turning protectionist, turning against the world, and is decided that we really don't need anybody. So if you ask me what's in the realm of the possible for reform NAFTA agreements includes the things along the lines of what I suggested.
Good. With that, I think we can conclude the NAFTA discussion, open it up to our audience, and see if we can make it from Mexico back to Europe. And I want to give people the opportunity to ask the panel some questions. If there are no questions, we're going to continue talking about NAFTA until 4:30 p.m. This afternoon. But Anders,
that's not a credible term.
Yeah, thank you very much. Thank you very much. I wanted to. Servas pointed out that the reason why fiscal and monetary policy was so tough that Angel complained about was that many countries did not have market access. By my count, for a shorter or longer period from 2008 to 2013, there were 11 EU countries out of 28 that did not have market access during some time. So, Angel, you sounded as if you thought that it was a mistake, or what you think should have been done in that situation, in broad terms.
So, hindsight is always a very nice place to be. But what I wonder is this. Imagine that in 2008, 2009, when the Bernanke Fed and other central banks decided to do quantitative easing, the ECB had done the same. Rather than focusing on providing liquidity to banks, they had decided to simply buy government bonds with the idea of keeping term premium lower and interest rates lower. I wonder if in that situation we would have had all these fears about breakup risk that led to the sharp increase in spreads in several countries. Because what happened was, because we didn't have that, then fiscal policies had to become procyclical, which is essentially what Servas was trying to say. There was even a further irony. That is, once we introduced the possibility of private sector involvement, or in other words, debt restructuring as a condition for a program, the news of a country rumored to be in conversations with the IMF for a rescue program led to an increase in spreads and not to a decline in spreads, because it essentially increased the probability that there would have to be a process of debt restructuring. That essentially created a lose-lose proposition for countries, because essentially the worse it got, and the higher the interest rates. Now, again, we can debate whether there were other reasons that led to that policy decision, but to me, in hindsight, that's the fundamental difference. And the reason why the US had a recovery that stretched in a straight line from 2007 to today, while the euro area had a double dip and a double recession.
Let's go all the way here on the left.
Thank you. Yeah, Kevin, you mentioned, you commented on like the prospect for some sort of trade arrangements between the U.S. and the EU, and the U.S. or the U.S. and the U.K. in the future, and you were more sort of bullish on like a U.S.-UK sort of trade arrangement after the U.K. and the EU sort of figure out like an arrangement. What would such a U.S.-UK trade arrangement look like?
So I'm a has-been central banker, so talking about NAFTA and trade is really quite an enjoyable. Quite an enjoyable exercise. So let me just say a few words about it, and I will tie this back to the Federal Reserve because that's my narrow parochial way. So it turns out about 85% of the world's financial assets are in Britain, the US, and Switzerland. Maybe those numbers are a couple of points lower. If anything, both our friends in Europe and we have suffered quite a shock through the crisis in understanding the solvency and the relative need for government backstops between and among our biggest banks. Under the guise or auspices of regulatory reform, Dodd-Frank and other regulatory reforms, we're back in Basel, Switzerland, trying to get agreement among the G20 and the world's banks about how to handle financial services that inconveniently cross borders, as if somehow this is a terrible, terrible thing. So among the things that I think would belong in a US-UK dialogue, I shouldn't call it a trade discussion in light of the separation from Europe, would be what are we doing about financial assets? What are we doing and thinking about it? My parochial judgment would be if the US, Britain, and sometime later the Swiss could come to agreement about how we think about our banks, how they're capitalized, what their liquidity should be. The other G17 would follow. This is quite radical stuff I'm suggesting, just to be clear. Most people believe that if a couple countries get together, then no one will want to do banking and finance with them. There'll be a race to the bottom. People will just be so keen in doing their banking with large financial institutions domiciled in insolvent countries. I don't believe that. I think if the three of us could agree on what real capital is, what our posture is on government support of banks, my view is the US should not be standing behind our big banks, as radical I know. We should not be prepared. We should not want to bail them out again. And other countries like the Swiss and the Brits, I don't know their perspective with their big banks, but I'll say something quite rude. I'm not sure they could afford to bail out their big institutions again because their financial assets are so large relative to their GDP. So I think there could be a race to the top. I would want to come to agreement on what the right capital levels, liquidity levels are, and let them trade securities in these countries and have something that's a financial system that's actually quite resilient. When I look at financial services, which is a large part of the UK economy, a large part of the Swiss economy, and as we know from the crisis, a consequential part of our economy, I frankly see preciously little real reform. I see us having done very little to bring market discipline back to these markets. I do not see a plausible, credible path by which the US government will unwind and resolve big firms that get into trouble. And I don't see a lot of comity between and among bank regulators, so we're sending double the number of people to these large institutions, and it's not at all obvious to me that we are closer to seeing who's got real problems and who doesn't. So again, to answer your question, the US-UK dialogue, I think financial services should be part of it. I think it would be prudent for us to be part of it, and I think the rest of the world would be wanting to do business with institutions that are resident in countries like ours, and that could bring real reform to financial services. That would just be one part of it. Just as a final point, again, I'm probably not the expert on the politics of trade, but I don't think that most Americans think a lot of Brits are going to come and take their jobs. I don't think that's perceived to be a risk. I happen to think it's important the U.S. lead on these things. If the U.S. is acting like there are trade deals we want to do, that we are open to the world, I think that has a very positive effect on the rest of the G20 in the world. If the world perceives us to be turning our back, to be uncomfortable with trade, to be restricting and protectionist, the world shrinks really quickly, and the kind of potential growth that we want on this stage becomes harder. So I like the symbol of it, but I also like the substance of it between and among other issues with financial services.
So one financial reform in the U.S. that has not happened, I think, is with regard to Fannie and Freddie, which have looked for a while like there were going to be real changes, and then they didn't happen. Do you regard that as a particularly serious problem?
I think it's a particularly serious problem. I think it has been a particularly serious problem for going on 25 years. I think Fannie and Freddie's insolvency in the financial crisis was one of the great tail risks that was the most foreseeable of any of the institutions that failed in the financial crisis, of which there were many. And for any of us to suggest that we have fundamentally reformed the financial system and we had forgotten to do anything about Fannie and Freddie looks to me to be something more than a glaring oversight. It looks to me to be a deeply troubling episode where we have not focused on real reforms across financial services and most of all in mortgages themselves. Fannie and Freddie could have been reformed for a decade before they had to be bailed out by the US government, the Federal Reserve, and the Treasury. We left the world with what I think used to be described as constructive ambiguity. Fannie and Freddie may or may not be backed by the US government. We'll let you know. Well, that turned out to be neither constructive nor ambiguous. We've now put these institutions in perpetual limbo, which is bad for mortgage finance, bad for the allocation of credit, and has been not even begun to be reformed. So if you want higher levels of growth and you want real reform in banking, Fannie and Freddie are certainly not examples, and I hope that we have not turned our other large financial institutions into cousins of Fannie and Freddie. We don't need more of them, we need less of them. As a final word, I'd just say I am not opposed to big banks. But big banks that can succeed as big banks should be able to fail as big banks. And I hesitate to believe that people that actually have responsibility, unlike myself, feel as comfortable as they're letting on that they have foolproof ways to unwind large institutions that get into harm's way. You think the Federal Reserve is unpopular now. You wait until that next phone call comes, as it inevitably will over the subsequent years about a big bank that gets into trouble. If I were they, I'd want to have a better set of reforms so that they could be unwound without putting at risk the Fed's standing and taxpayer dollars.
So Vaz, do you believe that the EU has a foolproof system of financial regulation and housing markets that can never get into trouble because prices will continue to rise?
Surely not. We may not have the same institutions that you have just talked about, which were so depressed and have been such an important role in going into the financial
Robert really
crisis.
drew out the optimism there.
So that we don't have. We still have quite some work to do on this. We certainly have, as Kevin has indicated, we also have problems with large banks in Europe, and to what extent the supervisory and regulatory system is already in place to cater for that. We have done a lot, on the other hand, with the BRRD. Restructuring and resolution is certainly the way forward, but we don't have yet the full architecture in place. We have started with some improvements on resolution and single resolution funds and mechanism in Europe, but we still not have a real fund, we still not have a real backstop. Yeah. So if ever we would come, and that certainly will come at one day, again, a new financial crisis, hopefully not in the next couple of years, but if it is later, then if further progress is being made both on the banking union and the capital market union, we would be in a better place to handle this, but we are certainly not yet there, so that's certainly the case.
I think we have time for one more question. Let's go right there.
Hans Roger VB. The question is for Mr. Oubide. If I understood you accurately, you seem to indicate that if there were a positive outcome on Sunday, the tail risk for French sovereign would probably go downward to some extent. However, we have to be mindful of the fact that in France we have Article 20 and 21 of the Constitution, which is similar to what we came to understand about, shall we say, I think it was the 12th Amendment of the Constitution of the United States. The point I'm trying to make here is that even if M. Macron were to win, which is somewhat of what markets anticipate, in 6 weeks we have to go back to the voting booth. And En Marche does not have, if you will, the kind of coalition which will back the reforms which the market seem to want. So I suppose the question I wish to pose to you, if I might, is given the possibility of les Républicains and le Centre coalition to actually win the legislative and to have a prime minister who is going to actually implement the policies which, to some extent, François Fillon was advocating, how do you handicap the possibility that, well, there's actually a reversal in market expectations, if you will, of tail risks?
So I completely agree that we will not clear the uncertainty on May 7th. We still have the parliamentary elections. Now, I think there are two levels of uncertainty, right? You have 4 candidates. You could argue 2 of them are pro-status quo and 2 of them are different. So if the final outcome is that the president is either Emmanuel Macron or François Fillon, I think markets will be happy. Then we go to the parliamentary elections, and as you say, the risk is that there isn't a workable majority. If the result is that what we need to do is a coalition between the supporters of François Fillon and the supporters of Emmanuel Macron, it will be okay. We'll need to see what kind of policy package comes out of there. The differences are not that big, I would say, in the bigger scheme of things. So François Fillon is probably more hawkish on fiscal policy than Macron. I'm sure they can find some middle ground. The same applies to the labor market reforms. The labor market reforms that are in En Marche platform are quite good. The ones that Les Républicains are presenting, I think, are also decent. So if we end up with a weighted average of those 2, I think it's still a good outcome. And the important thing, I think, more is just the opposite. It's eliminating the tail risk that comes with the possibility of some of the other candidates really becoming president, and then also not having a majority in parliament, which would be also a situation of tremendous uncertainty, right?
Good. And with all tail risks eliminated, I think we're done here. Thank you very much to all of you. Thank you all for coming.